All right. Good evening, everybody. Thanks for joining us tonight. And I wanted to start with a little confession. 9 months ago, this deal actually came across our desk through our group Connected Capital, which is a group of fund managers. And I passed on this deal, and I passed very quickly. I heard distillery, and I thought, yeah, that's probably not for us at Walker Well. That's not really our thing. And that's okay. As investors, we don't have to fall in love with every deal. In fact, most of the deals we look at don't make it through our process. But here's what happened. Over the next several months, I kept hearing about Eastern Light. I saw several friends and colleagues, people I respect tremendously and who are very diligent investors, taking substantial positions in this deal. And I thought, okay, what am I missing here? So I started making some phone calls, and something interesting happened. Nobody talked to me about bourbon. Nobody talked to me about whiskey prices. Nobody talked about creating the next Jack Daniels. They talked about manufacturing. They talked about storage. They talked about recurring revenue. And that really changed my perspective. What I realized was that this isn't really a bet on consumer tastes. It's a B2B business with multiple revenue streams, hard assets, and some pretty incredible tax advantages. But here's the other thing that changed. 9 months ago, there was still a lot of execution risk around getting the capital stack in place. Fast forward to today, and roughly another 10 million plus has been either funded or committed. Senior financing is expected to close in July. So, the lender has already approved. And what really struck me is this. This thing is happening, right? They've gone from, hey, can we pull this off? This is just a dream, and dream without capital is just a dream. To okay, they're gonna actually build this thing, and I think that's an important lesson for all of us. Good investing isn't about being first. It's not about having to say yes immediately, and it's certainly not about being right all the time. But sometimes the smartest thing you can do is say, I'm not convinced yet. And then when the facts change, be humble enough to change your mind. That's exactly what happened here. So don't make the mistake I almost made. Don't hear distillery and immediately check out. Listen with an open mind, ask tough questions, kick the tires, and do your own due diligence. And then decide for yourself, because that's exactly what we did. And after revisiting the opportunity, we're excited enough about it that Walk of Wealth has negotiated a $1 million allocation that we're making available through our fund. Now, enough hearing from me. I'm excited to introduce the team who's been living and breathing this project every single day. I'm gonna give you guys your moment to introduce yourself. But this is Caleb and Mike and Cordell, the founders of this incredible project. Thank you. Okay, here's our intro slide with disclaimer. I'm not gonna read it, but you can read this on your own. The deck will be available, but. Okay, so yeah, that's good. All right, so for those of you who don't know me, real quickly, I'm Dr. Johnny Withanacci. I'm an endodontist by training and the founder of Walk of Wealth. Over the last 15 plus years, I've been obsessed with one thing, helping busy professionals create financial freedom through passive investing. At Walk of Wealth, we spend our time evaluating opportunities across real estate, private credit, energy, private equity, and operating businesses. And honestly, we reject far more deals than we accept. Our goal isn't to chase shiny objects or swing for the fences. Our goal is to find opportunities where we believe the risk-adjusted returns make sense and where there are multiple ways to win. We love hard assets. We love recurring revenue. We love alignment with sponsors. We love tax efficiency. And we love opportunities where we believe the downside has been thoughtfully considered. That doesn't mean every investment is low risk. In fact, some opportunities come with execution risk. But we believe that if you diversify intelligently, stay disciplined, upside investments can play a very important role in building long-term wealth. And that's really why we're here tonight, not because of our traditional multifamily deals or self-storage deal, not because this is a sure thing, and certainly not because we think everybody should invest. We are here because after spending months, and we've really done deep due diligence, revisiting our assumptions, watching the company continue to hit major milestones, we felt this was a unique opportunity that deserved to be shared with our community. And as always, our goal tonight is education first. Listen with an open mind, ask tough questions, do your own due diligence, and decide whether it fits your goal and your portfolio. All right, Caleb, I'm going to hand it over to you.
Sure thing. Well, Johnny, thank you so much. We've been incredibly impressed with you, your fund. As you mentioned, Johnny is a member of a large aggregate who has been amazing to Eastern Light, taking substantial positions, not because they hear distillery, but because they look at the underlying fundamentals of what the distillery represents. And it proves a business plan and a business strategy that is justified within any sort of field. So, quick intro to Eastern Light itself. We are a B2B manufacturing and storage company that happens to serve the distilled spirit space. Essentially, we create a commodity product, a whiskey in this case. We sell it before it is ever produced to a third party, meaning that we take virtually no inventory risk. And then we become multifamily for barrels. Whiskey is unique in that it is an asset that must be stored. It must mature over the course of the better part of a decade before it's commercially accepted. What this means is that many of our clients have to have a place for their barrels to reside for 5+ years. And during this time frame, it generates recurring revenues for the distillery that also generates some really nice tax advantages. We're going to walk you through all of this, but before I get deeper into Eastern Light itself, I'm going to introduce you to an outsider from the project. Mike Stanchina is managing director of Matterhorn Securities, who is the investment bank who is advising the distillery, our actions, and is responsible for many of our partnerships to date. So what I'm going to do is I'm going to let Mike give you just a few things to look out for as you're walking through our deal.
Good evening. Thank you, Caleb. My name is Mike Stanchino with Matterhorn Securities. It's a pleasure to present to everybody tonight. And before I jump in, just to give you a quick background, our firm, we represent Caleb and Cordell in raising the equity. We were mandated late last year to represent the firm in raising the equity. And my partner and I, we've raised over $100 billion worth of capital and executed M&A. We're former Wall Street investment bankers, and we've been on our own for a number of years. And I tell you what really blew us away when we met Caleb and Cordell was the level of professionalism and what they did to get to this point. It's just absolutely impressive. When my partner and I jumped in and started doing due diligence, we were just really impressed on what they did. Usually when our clients approach us for equity, they're very early stage. And it's pretty much an idea, just as Johnny kind of alluded to earlier in the presentation. But when we met them, they had over $40 million of debt already teed up between $25 million of USDA financing and $16 million of C-based financing. So they had $41 million of the debt stack rounded out. And they also had over $10 million of equity already raised. So we were essentially bought in to raise the last $20 million of equity. And we'll get into the specifics around what's remaining on the capital stack, but essentially 72% of the cap structure was already funded. And we were just extremely impressed on where the firm was. But what's really interesting about this project is the early cash flow on the project. It is a development project, and Caleb will get into the specifics along with Cordell, but there's early cash flow here in this deal. And additionally, it's an asset-backed security. So there is assets here and there's plenty of coverage. And there's really nice tax efficiency here with the one big beautiful bill. You'll see that there'll be an added tax benefit of investing in this project. And there's a lot of upside in this project, just the quality of the cash flow. We're looking at 60% gross margins and over 55% EBITDA margins. But we've really enjoyed working with these guys, and I think you're going to be impressed as we jump into the presentation. And with that, I'll turn it back to Caleb. Thank you.
Fantastic. So before we tell you a whole lot about Eastern Light, we want to introduce you to the founders and give you a little background on ourselves. My name's Caleb Kilburn. I'm co-founder and master distiller for the venture. I started within the distilled spirits industry roughly 14 years ago at the ripe age of 22. I was able to become introduced to a family that was about to revive and build a new distillery, where I was able to work alongside Cordell in really shaping the narrative and the space that surrounded it. I did everything from building out the production plant to commissioning the equipment, and ultimately ran operations there for right at a decade. During that tenure, I was recognized as the youngest master distiller within the bourbon industry in 2018. In 2019, we were the Global Craft Producer of the Year. And in 2019, I was recognized as Master Distiller of the Year. And before we go any further and explain the next steps that followed, I want Cordell to introduce himself as well.
Sure. So Cordell Lawrence, born and raised in Louisville, Kentucky, and really grew up in the industry. So worked at a large conglomerate known as Brown-Forman Corporation. That's the parent company of such famous whiskey and bourbon brands as Jack Daniel's, Woodford Reserve, and Old Forester. Traveled to 6 of 7 continents, every continent but Antarctica on behalf of that company, growing those iconic brands. And by happenstance, was introduced to the Peerless family, the Taylor family, that was resurrecting this once great pre-prohibition brand. And that's where Caleb and I intersected, grew that to be the best craft distillery in the industry, and Caleb eventually becoming the Master Distiller of the Year for the industry in 2023. And with that, we'll take you through kind of the basic process of whiskey making. Many of you may be familiar with this process already, but essentially it's what we call grain to glass. So all these steps would be undertaken by a traditional model of a singular brand-focused distillery. There is a number of entities out there, nearly half the bottles you see on the shelf, essentially skip steps 1 through 4 and go straight to 5 and 6, acquiring the liquid asset, the new fill barrel, or aging inventory. Great examples that Caleb has on the slide here are Blue Run, recently acquired by Molson Coors, a large beer conglomerate that's making a play in distilled spirits. Bell Mead out of Nashville. Of course, Bullet, owned by the largest conglomerate in our industry, known as Diageo. Michter's, a privately held company, and then Barrel Bourbon as well. All these have the same thing in common, right? They're all American whiskey, specifically Kentucky bourbon in terms of the original source of this. None of them own the means of their production. How do they come about with that production? They utilize a contract distillery such as Eastern Light Distilling. So the traditional model in terms of contract distillation is really an obscured product origin. That contract distillery, most often, until the case of Eastern Light, prevented that brand from affiliating officially with the distillery or the distiller. So they locked them under NDAs. It's really a smoke and mirror situation where that lack of affiliation prohibits and inhibits their ability to grow in the marketplace. With Eastern Light, we kind of break the shackles, right? Completely open to and embrace affiliation as much or as little as the client desires. So they essentially, by becoming just a customer, have the affiliation they need to succeed with distributors, retailers, and ultimately with customers to have that level of authenticity that's needed to succeed. And in terms of limited customization, that is the current model. With Eastern Light, again, we break the shackles apart. It's infinite customization. It's not ordering off a short set menu. It's literally anything you want, from single malt whiskey, American style, in this case, that's a recently newly designated American whiskey category, all the way up to 3, 4, and 5 grain. Sounds simplistic, sounds rudimentary, it's revolutionary. None of this exists, as well as that affiliation piece, until Eastern Light came to be. And predatory pricing, that is commonplace in terms of the new fill price they pay for that first barrel when it's filled for them. That pricing model is really predatory in many ways, because over time it's gonna decrease their margin and put pressure on their margin and their profitability throughout the life cycle of that brand. And then again, like I've alluded to earlier, the competition with distiller-owned labels, it's really a conflict of interest. They have their own house brands in many cases. So great example here is Bardstown Bourbon Company in Green River. That combined entity was acquired by Pritzker Capital. As that happened, of course, private equity firm gets involved. They focus on higher margin opportunities, which is their own labels. So they are actively trying to shed, right, those contract customers, and they prohibit any kind of affiliation locked under NDA. Similar situation, Wilderness Trail. In that case, it was acquired by Campari, a large Italian conglomerate that is the parent company, Wild Turkey. And then the smattering of barrels there, kind of on the three shelves, was the combined entity of MGP and Lux Row. Same situation at Indiana, kind of contract distillery, a house of brands distillery in Kentucky, merged forces. They had some contract business. They're actively exiting that to focus on their own labels because they don't want them to compete with that contract competition. And with that, I think it's Caleb again
Yeah.
here. Yeah.
So, as Cordell said, essentially, when you're looking at roughly half the labels on the shelf, they rely on third-party manufacturers to create their spirit and third-party storage companies to help it mature. The bulk of people who utilize this currently face a lot of headwinds because the people who currently supply their needs, who fill their supply chain, are not their partners, are not cheering them on, are not doing everything in their power to help them succeed. That ultimately led Cordell and I, through a lot of solicitation from a lot of people who are looking for us to provide these services, to found Eastern Light Distilling. Essentially, what we want to do is provide these non-distilling producers, these NDPs, with everything that they need to succeed that they're not currently receiving from other production partners within the space. That's going to start off with dropping the NDAs and inviting them to call our facility and our partnership their home place. They're welcome to be within our gift shop. They're welcome to be within our tours. If they have a distiller, we want them to feel comfortable making their craft, making their spirit at our plant. If they do not, we're willing to lend my name, image, likeness, or that of our production crew to add authenticity to any of these sourced brands. Now, where others force clients to pick off of a menu or are very punitive when it comes to customization, there is nothing that is off limits to these clients to where they can select different yeasts, different grain profiles, different mash bills, different barrels. Essentially, any lever they want to pull to customize the product, we are able to facilitate. Now, while we're adding more as far as what we're willing to give them as far as customization in regards to partnership, we're doing so at a sharp discount compared to what is industry standard. Right now, when you're looking at custom contract production, you're typically seeing prices start at $850 and up. Meanwhile, our ambition is to address this need for roughly 80 cents on the dollar compared to our competition. This is not something where we're doing so strictly by sacrificing margin, but by focusing on the fundamental strengths and foundational elements that Eastern Light enjoys that allow our cost basis to be lower than our competition, and then we pass that savings on to our customers. All of this generates a supply chain stability that does not exist anywhere else within the contract spirit space and is ultimately why Eastern Light will succeed. Now, even though there's a lot of different things that we're going to touch as we help these brands, the core three elements that we have modeled is contract distilling, which is where we take a client recipe, we create the product, and when we sell it to that party. Contract storage, which is where we take that barrel, we put it away in a barrel warehouse where it's going to spend the next 5+ years of its life maturing. And while it does so, it's going to generate rental income that the distillery will receive. The third vertical is barrel brokerage. Essentially, right now, we operate in the space buying and selling barrels on behalf of different clients, helping them find the best price as a seller and best price as a purchaser. Right now, we are doing this primarily from inventory that Eastern Light does not own. But as we grow and as we mature, we want to allocate up to 10% of our production to be parked to the side, not for an Eastern Light label, to fuel the brands of the brands that we'll be representing and their capacity. So all of these three stack to create a very compelling financial statement of what Eastern Light is capable of becoming. First and foremost, we'll be able to enjoy that immediate manufacturing revenue where we'll be able to pull in roughly $200 per barrel. This is a large facility that's capable of producing over 100,000 barrels per year. And that immediate revenue allows us to get into business and start up. The contract storage revenues are going to start very slow because when we start out of the gate, there's not going to be anything in the warehouse maturing. But as we build that up, we have the capacity to store up to 500,000 barrels at any given time. And with each barrel, within industry standard rates, paying around $3 per barrel per month, we are able to build a juggernaut that is capable of producing over $1.5 million a month strictly in real income. Now,
Yeah.
the upside swing is associated with the barrel brokerage, where we're able to take our very low cost basis as a manufacturer, allow the whiskey to mature, and then flip it as a mature product to brands. But that is something that does not come online until we get into the 2030s. Essentially, we have three very profitable, very nice revenue streams that rely on completely different portions of the equation from a financial perspective. Essentially, we're able to make that immediate, secure margin with the core manufacturing. We know exactly what we're going to make when we do the contract storage through recurring revenues. And then the real upside swing that diversifies it and makes something really nice is on that barrel brokerage. Now, the core centerpiece of all this is the distillery, which is seated in the middle of our 230-acre campus, capable of producing over 100,000 barrels per year. And the location and nature of the build is really where we're able to generate a lot of the savings that we experience on our cost of goods. First and foremost, this is one of the biggest contract-focused distilleries in the world. It will be the largest dedicated contract facility in American whiskey. When we're actually looking at the process design, it is engineered with modern technology. We have several patents in place that will be aiding and assisting our edge over a competition. But the fundamentals associated with logistics are where we really are able to run up the score. The most expensive component in creating a barrel of whiskey is actually not the whiskey, it's the physical container of the barrel that you fill. When you are looking at the actual cost breakdown, it accounts for over 50% of the cost, and it is the most expensive component of the whiskey barrel to actually transport. So we are gifted in that we're 7/10 of a mile from Independent Stave, who is the global producer, the global leader in American whiskey barrel production. Their most technologically advanced facility is roughly 7/10 of a mile from our principal facility. Not only does this save us on freight, which is less than a 2-minute drive, it also saves us on in-transit damage, which is the leading cause of leaks aside from just standard wood defects. This allows us to give our clients a better price because we incur less cost, but also a barrel that is going to be more seaworthy and capable of carrying their whiskey to maturity. Associated with the supply chain outside of that, we're surrounded by grain farms who, if they're not selling to us, they're taking it roughly 2.5 hours away and putting it on a barge. And possibly most importantly, is waste stream partnerships through the local cattle farming community. Some distilleries in Central Kentucky are paying as much as $100 premium per barrel just to mitigate their waste stream. Meanwhile, because of our location, we have agreements in place that take it away from our facility at zero cost. If we only were able to succeed through this $100 head start per barrel, that's roughly a $10 million a year head start over a competition. Now, we are in the process of constructing. Matter of fact, I had a very nice conversation and meeting earlier today that lasted about 3 hours with our construction firm, which is Gray, who will be completing the facility, currently forecast to be in H2 of next year. The core focus of today, as Johnny mentioned, is building the facility to operate, to get up and going. And this is where timing is actually working in your all's benefit. Several months ago, when we first introduced our deal to Connected Capital, it was fairly early in our raise. We just had $11 million under our belt. We'd arranged the debt financing, but we hadn't progressed to where we are today. Since then, we have received more than $5 million in cash subscriptions. We have signatures on the page for another 6.5 that is going to take us above the threshold at which the equity closes to build the facility, to equip it, to acquire the land, which has already been done. And all of those things generate the asset that will be the financial engine to make this happen. Now, today we continue to raise because we ultimately want to add additional storage facilities. We want to reduce new and future debt and ultimately optimize the business. But the greater threshold has already been passed. So today we continue to offer, we continue to work, and that was where our partnership with Walk of Wealth really is coming in very fruitful. But before we get into the specifics of their offering, I want to point out two really important things. First is the scale of what we're building and what the exit potential looks like within this space. Recently, we had two very profitable contract-focused distilleries. One was acquired by private equity. The other was acquired by a global conglomerate called Campari. Bardstown Bourbon Company is slightly smaller than the distiller that we are building. It recently sold at a 14x multiple to Pritzker Private Capital with intent of them holding it. They continue to operate in the contract spirit space, but they have made a heavy push to focus more on their own brand, and they have actively been flinging off capacity because they ultimately want to internalize as much of that for themselves as possible. So there's available market share that they are pushing out into the contract spirit space. The other is Wilderness Trail, which was sold to Campari, which is the parent ownership of Wild Turkey. Essentially, they needed more capacity to fuel their American whiskey needs. This facility was very public because it was sold to a publicly traded company. It sold at a 16x EBITDA multiple, a flashy $600 million transactional valuation, despite it being roughly 5/6 the size that we're building. So we have a very nice advantage over each of these in the scale and the location that we're building this facility. Now, I'm not going to say that we're going to reach mid-teens on exit. The market was white hot when these transactions took place, but working very closely with the advisors and consultants that facilitated each of these transactions, they felt moving forward a 7.5x even multiple would be more than conservative. And with the scale that we're building, we expect the final exit multiple or the final value of this exit to be greater than Wilderness Trail. And Mike, I believe that you were getting ready to chime in, so I'll stop talking for a second.
Yeah, and this slide gets us excited. And I think I mentioned it earlier, the 60% gross margins that this is anticipated to throw off, along with the 55% EBITDA margins. We're looking at almost $100 million of EBITDA. The precise number, I believe, is 98 million, 8 years down the road. And given that kind of the size growth and the cash flow profile of this business, I think this is an easy 10 times exit multiple. And if you kind of take a step back there, you're looking at about $1 billion of enterprise value with really nominal debt on the business at that point. So the IRR and the MOIC is fairly significant. And I think when we initially got in and did our due diligence, our broker dealer really wanted us to go in and diligence the model pretty extensively because of the nice cash flow profile. And we spent a lot of time with the team, and it's very conservatively laid out. So at a 7.5 times, I think that's extremely conservative, and I think the upside could be pretty significant here. But with that, I'll kick it back to Caleb.
The second thing I really want you all to focus on and learn more about is associated with tax. As we started laying out our financials, as we started building this out, we saw that a lot of the pro-manufacturing legislation that had passed through the tax bill ultimately applied to us as a distillery. Essentially, when we're looking at the bonus depreciation, it allows many of the assets generated by the distillery to be depreciated the day it goes into service, allows the initial build out to generate roughly a $45 million depreciation event. Now, this is not a one-time benefit because the principal expansion item of the distillery itself is called a rickhouse. As we're looking at these storage facilities, even though they will have a lifespan of more than 50 plus years, the IRS has set a precedent roughly 40 years ago of treating these as equipment, qualifying them for the same day one depreciation. So if we're looking at our standard operations, if we're building a new rickhouse roughly every fourth month, if we're at full capacity, that is roughly another $18 to $20 million a year of bonus depreciation that further reduces our taxable income. So what we're looking at is, because we're an LLC taxed as a partnership, being able to package all of the tax loss from construction and send it out to investors to allow them to offset other gains within their portfolio. But then they're able to further optimize the revenue stream that they're going to be receiving from Eastern Light through the Walk of Wealth Fund to show a much lower tax burden than what they're actually receiving in cash distributions. And to give you just an illustration of this, we have worked with Walk of Wealth to showcase their two asset classes and what the actual anticipated performance of each would look like. As Johnny mentioned, we work very closely. We have allowed them a $1 million allocation of the assets associated with Eastern Light Distilling. He has already arranged roughly 200,000 of subscriptions that will be funding soon. And currently there's roughly another 800,000 that will be available to the community. He is offering this through two share classes. First, for the general community, a standard fee split between the investor and the fund. They are receiving the vast majority of the preferred return on an annual basis, and it still produces a very strong return multiple. But he also has his mastermind members that takes a much thinner margin for the fund. It allows much more to flow through to the investor. Both are great asset classes that we hope that you are able to take advantage of. Now, when we're looking at the standard asset, if you were to say someone were to put in $100,000, we expect this thing to start cash flowing and start flowing to investors in as little as 2 years. Our current expectation is that the first bite of the apple is going to take place in 2028. Now, this is also going to be disproportionate in regard to its reward with the taxable income line on the bottom. So in this chart, we have combined not just the cash flows associated with investment, but also the taxable income allocation for each individual investor. So what we're showing here is if someone were to put in money in 2026, in 27, when the facility is complete, they're going to have almost a 1-to-1 ratio where the 100,000 they put in is immediately served to them as a loss that they can throw off of other taxable income within their portfolio. In 28, when we distribute that 21,000, our expectation is that the K1 is still going to show a loss, meaning that that 21,000 is not coming through with any sort of tax liability. When we're looking at 29, it continues to grow. And even when we get into years where we start to pass along an asset or an allocation of income that would be taxable, it is almost always a fraction of the actual proceeds from the investment itself. Now, when we look to the future, our belief is that based on the exit multiple, based on the financials that were prepared by some of the industry's leading experts, we believe that there is an IRR that is going to be roughly 40% that would be realized by the investors in this share class. When you go to the mastermind class, it is the same song and dance, but is slightly more potent due to the reduced fee structure associated with the fund. Again, our expectation is that you all are going to be able to drastically reduce taxable income in 2027 through the K1 that is going to show your allocation of loss from that depreciation event. And then you have this ongoing cash flow scenario where it is always tax advantaged moving forward. Now, I will point out the asterisk at the bottom. On that exit, this does not include capital gain tax. That is an individual example that every one of you all will have to talk about and work through with your tax advisors. However, it does grant you all quite a bit of flexibility in how you're able to perform a little tax triage to make sure what you make is retained.
Caleb,
Now,
real quick, can you
yes,
go back
sir.
to the slide? So this
Do
is
you
on
want
100,000.
the
Yeah, you can even go. Yeah, you go back even one more. Yeah, this one even is good. So now this is on $100,000 investment. I just want to kind of point out. So looking at almost 100% bonus depreciation for 2027, right? So you get almost 1-for-1 investment, and then you're saying that the cash flows on $100,000 investment in 2028, investors should expect to receive $21,000 in 2028. 2029 is 15,000, 23,000. So very substantial cash flows, 37,000, and then by 2032 when the business is ramped up, very meaningful cash flow. And then if you look at the depreciation on the row underneath it, a lot of that income is offset by the depreciation. So very, very compelling. The cash flows are tax advantage dollars. And the IRR, look at the IRR. I mean, I'm even embarrassed to even say the IRR, but looking at a 39% IRR, right? And then so a 12.5x equity multiple. Now, these are just projections, right? There's not guarantees, but 12.5x on $100,000, it nets you, over $1.2 million. And this is the general community, right? This is this is for the general community. And the other thing you didn't mention, Caleb, is the $40,000 minimum for general community and a $30,000 minimum for mastermind members. So we made the minimum a little bit lower on this deal, since it's a little bit more on the speculative side, but obviously very, very exciting, very, very compelling returns. I'll pass it back to you, Caleb.
Absolutely. So as far as where we sit today, and this is a really important milestone that Johnny had mentioned earlier, we actually had another wire come through today. We're at 15.9 now. We have signatures that will be coming in with closing at 6.5. And that leaves us roughly 7.6 million that is currently available, of which $1 million allocation has been allocated to Walk of Wealth. This is a really important threshold that we are surpassing, where we are closing our senior financing that funds the construction of the facility, the startup capital, the operating capital. Essentially, the threshold that we have already surpassed starts the business and secures what we're building. Currently, we're expecting on July 20th, or probably that week or the week following, to close the senior financing with Magnolia Bank and the USDA, as well as Clean Fund through their CPACE lender, which is going to be Energize Kentucky. Two amazing debt classes that are very long paper, very friendly terms that allow us to build and operate the facility. And this threshold is really important because it introduces the asset backing that protects our membership from downside. When you're looking at our immediate spend, we're going to take roughly a $51.2 million CapEx project, generate an asset that is appraised at $55 million the day that the lights are ready to turn on. Essentially, this is a real estate development deal that you'll have access to operable business to follow. Many of our investors are traditionally real estate people that view this as a development plan with a free option to what comes thereafter. Now, there are some headlines within the industry I want to go ahead and attack head on. I want to give you all a strong bit of why we are so confident taking this project into the world. And the easiest place to look for the performance of the overall American whiskey market is the Distillers Council of the United States. There's a lot of headlines out there that you'll see regarding people not drinking. You'll see impact of tariffs. You'll see impact of cannabis and all sorts of things that portray a very negative light on the American whiskey industry. But when we're looking at it, the industry was regarded as absolutely white hot pre-COVID. At this time, we were selling in the low to mid 20 million cases per year range. And today, we have grown more than 3.5 million cases from the historic high point. The only negative perception that is attached to American whiskey is comparing it to the heights of COVID. We are talking about a pandemic, a 1 in 100 year occurrence that kept people home, government shutdowns, you had people receiving checks, and all of a sudden consumer habits shifted. As opposed to the mid to upper single digit CAGR growth that we had experienced for the past 20 years, all of a sudden consumption skyrocketed. People were staying home, they were pantry loading, they were loading their shelves, and it led to an unsustainable growth pattern that we have since relaxed from. When we're looking at those COVID years, it grew to new heights, and we have gradually and slowly fallen from those heights to what is still an incredibly profitable market that now more than ever sets the stage for contract economy, efficient, high quality producers like Eastern Light to come in and consolidate market share. When you're looking specifically for tariffs, when you're specifically looking for other things that have been portrayed to negatively impact American whiskey, this is the data for 2025 on revenue numbers. It was the second strongest performing category, receding only 0.9% compared to many other categories of spirits that had fallen off substantially more. It was less than a third the fall off from vodka. It was less than 1/6 the fall off from rum. When you're looking across different categories of spirits, not every one is the same. And that is even true within American whiskey itself. When you're looking at the global providers who are succeeding and receding in this space, we're combating a trend called premiumization. This means that consumers are reaching for higher quality goods, they're reaching for things with narratives, they're shying away from standard low end offerings and looking for things that have authenticity, story, and credentials. That is where Eastern Light is able to make many of these items that are necessary for success moving forward accessible to the half of brands that do not have their own story, that do not have their own distillery, and we make that accessible. Now, I do want to point out one more thing as Johnny was talking about the upside, the swing, what Eastern Light represents. I want to point out something that should give you all quite a bit of confidence in the viability and path forward for Eastern Light. Right now, we're expecting our 2028 pricing to undercut the existing market by roughly $200 a barrel, where others are selling for $850 plus. We have forecast to be able to sell at roughly $650. We're addressing needs for roughly 80 cents on the dollar compared to other needs. Our current forecasted sales number for storage, industry standard is $3. We have allocated $1 per barrel, meaning that we're going to come in roughly 1/3 of what is the industry standard for storage. And still yet, this would generate an operating income of roughly $16.5 million through 90% of our capacity being allocated to contract production. The interest expense at this point in our life cycle is only $4.3 million, meaning that if we hit roughly a quarter of our forecasted pro forma operating income, we are servicing our debts, we are living, we're paying our taxes, we are continuing to grow. If we half, we're going to be able to make our total preferred return and distribute that to our investors. All in all, when we look forward at the path ahead, the threshold at which that we have to succeed is very minimal for us to live, but the opportunity for us to grow, for us to thrive is immense. So with that in mind, I am going to pass it back to Mike, who's going to point out just a few more assets or a few more components of our investment. And then we're going to jump into Q&A because we ultimately want to hear from you all and understand more about what excites you or maybe concerns you about this investment class.
Great. Thanks, Caleb. If you can go to the next slide, that'd be great. Perfect. Just some highlights here. I mean, like I said earlier, this investment is very, very interesting. These guys have done a great job. I mean, you've seen the market. The market, it's an explosive market for contract whiskey distillation. As Caleb said, it's B2B. It's all about contract whiskey and being the low cost producer, providing, an excellent product with excellent margin. There's early cash flow here, a fast payback. There's strong investor economics. These guys are, they're very humble, but they are world-class founders. They have an incredible track record here. Low-cost premium producer in the U.S. And, they're solving the industry bottleneck with a modern sort of scalable platform. It's a tax advantage structure. And, Kentucky's structural advantage and high economic multiplier. But they're positioned on the right side of a long term on the alcohol trends, and it's a proven exit path with premium valuation multiples. And like I said earlier, that 7.5 is very conservative. We think very with a lot of support that this thing is going to be greater than 10 times. But with that, thank you very much. And I just want to make it known I'm available for any sort of questions, and we have plenty of due diligence materials that we can work with Johnny on here on this investment opportunity. But with that, thank you, Caleb. I'll turn it right back to you.
Well, I'm going to be a turnstile because I'm going to pass it back to Johnny. I do want to say that the portal is open. You're welcome to go in, learn as much as you can about us. As Johnny said, do your diligence. If there is a bit of interest through him, you have full access to myself, Cordell, my co-founder, and then Mike. We ultimately want you all to get very curious. We want you to get into the weeds and learn as much as you can because our confidence level that this will be an asset class that makes sense for you all and continues to grow the more that you learn. So with that, Johnny, I'm going to pass it back to you to MC, and we would love to hear from you all as you have questions, and we'll kind of shift into Q&A.
Great presentation, guys. Very good, very compelling. It's very exciting deal. I'm very excited about it. So if you guys questions, this is you guys were here. This is the advantage you got of being here. The founders are here. Ask questions in the chat. Feel free to do that. If you are interested in this opportunity, I put the link in the chat. You can go in if you haven't created. This is the link to our fund. So if you don't have an account yet, you have to go in and register, and you can see the deal. You can see all our due diligence. There's a ton of documents there that you can see how the depth of the due diligence that we did. If there's questions, email me. I'm going to put that in the chat as well. And yep, so that's it. So if there's okay, do we have any questions? Looks like there's
It looks
one.
like we have a question. Yeah.
Yep.
And we didn't mention this.
I'll read it out to you, Mike, and you can go ahead. Are there?
I'll turn it over to Caleb or Cordell on this one.
Sure.
It's a good one.
Are there already signed customer contracts, or is this based on expected demand? This is an excellent question.
Yep. So right now we have letters of intent for roughly 41,000 barrels per year for the first 5 years of operation. That is roughly double the break even associated with the business. Now, at this point, they are not binding contracts. I do want to be very forward and clear with that. Essentially, what we're looking at is when we transition to the vertical phase of construction, that's when we'll be able to maximize the leverage and start putting people in line. Until we have a defined construction schedule of knowing exactly when we turn on the still, it is very difficult for some of these purchasing groups to start allocating the production because essentially they're either taking it away from someone else or they're raising funds to finance that. So with that in mind, we have a very strong case for what we're doing. And Cordell, maybe this is a good opportunity for you to talk about kind of our ideal customer base and really who we've been able to find a lot of success with thus far.
Yeah, sure. So what's interesting is in terms of that pricing difference, that low cost leadership, we didn't necessarily describe that in great detail just yet, but I'll do that right now. So historically, those contract barrels, new fill barrels were just above $1,000, around $1,100 on average. As of late, they've been closer to 850 to 900 from the large scale contract distilleries in the industry. And we are introducing $650 barrel pricing. So we're undercutting the market by hundreds of dollars. So this is a game changing, a margin changing aspect of what we're doing for the industry, what we're bringing to bear here. So that has attracted anybody from barrel investors and barrel investment syndicates who see it as an alternative asset that appreciates and grows over time. They liquidate at that time and take those advantages when they can, as well as traditional brands, right, that are trying to offset their cost of even a small facility they're operating that's at an economic disadvantage and a cost disadvantage, because all the advantages we have, that's a real easy conversation for us to have. Also, given just our depth of relationships in the industry, we're already actively in the barrel brokerage space. So, for example, Terry Bradshaw, famous Super Bowl quarterback, we were able to increase their margin from 20% to 60% with aging inventory available in the marketplace because they were experiencing that predatory pricing that we alluded to earlier, which is a major stumbling block. Also, new to market brands that are looking for the most economically advantaged situation to go into. We are helping them on that aged inventory situation. We're also helping them with that new fill contract conversation, which has led to us getting roughly 40% of our barrels already under LOI. We expect that number to get up to probably closer to 75% within 3 months of being operational and then closing that out within a few days after being operational. I think, Caleb, if you can, not to be too long-winded, but go back to the slide that says 0.9%, where American whiskey is kind of the second best performer. And you'll see why I'm going to point this out. But an interesting caveat, right? So who's the best performer, right? So it says cocktails and RTDs. RTDs is an acronym for ready to drink. So you see that explosive growth of 16.4% total growth there. That is interesting to point out because you still have to have the distillate, right? The distilled spirit is the core element, the fundamental element of that canned or bottled cocktail known as ready to drink product. Because of that explosive growth, most of those brands out there don't own the means of their own production. They are buying bulk spirits that typically are not aged. So I was just in New York at two leading industry conferences, and one known as BevNet, one known as BCB. And both of those, I was able to interact and have formative conversations with those suppliers in terms of supplying the solutions of the co-packing, but not necessarily the alcohol. And that is leading to really exciting conversations and providing large scale, big volumes of alcohol that takes little to no aging that then is applied to this RTD category, which really is appealing to the Gen Z because of the convenience and the accessibility factors of that product. It's kind of an entryway into adult beverages as a whole. So we're excited about that as well because we can kind of play the artisanal craft piece. We can also play, the volumetric piece at scale.
All right, great guys, excellent job. So if there are any questions, let us know. Like Caleb had mentioned, we have a $1 million allocation. We already have $200,000 of soft commitments. Preference we expect this to be fully subscribed fairly quickly. So if you are interested, make a soft commitment. If it's a range, put the higher amount in so you can at least reserve your space. You can always decrease your allocation later. Mastermind members will get preferential treatment. All right, guys. Thanks again. We will catch you on the next deal. Thanks, Caleb, Mike, Cordell.
Thank you, Johnny. Thanks, everybody.
Thank you all.
Thank you.